What is going on, everybody, and welcome to another weekly update. And what I like to do in these videos is provide you guys some upcoming earnings, some upcoming events to get you prepared for the week ahead. If that sounds like something you're interested in, consider subscribing, as I do also provide a technical analysis on Sundays, and I do also provide a daily pulse on the market on X at Hemi137, so you can check me out there as well. But before we get started, remember to drop a like to get this message out there, to get a little more people informed of what's going on in the market. So let's recap. We've had one of the most historic weeks over the past week. And if you don't understand the significance of what just happened, we are about ready to tap into what exactly just happened this week, as it was, like I said, very historic week. Again, coming into this week, we were anticipating a 25-point basis move essentially about a month ago, is what we were expecting. At least that's what I was expecting, that it would be roughly 25. Anything more than that, I think, would be potentially a little aggressive unless you are behind. With that being said, what we got over this past week was, as we were coming into this past week, we started getting more. We started hearing a lot of noise, I should say, over from a couple different people that there's a strong possibility that we'd have a 50-point basis move. And I started believing it the closer we got to Wednesday. And then on Wednesday, obviously, we had the report come out at 2 p.m. Eastern Standard Time, 50-point basis move. Powell came on about 30 minutes later. The verbiage changed in the statement that came in, and essentially what was initially said was they are starting to see essentially an employment softening, which is something we've talked about since Jackson Hole. There's been a lot of revisions on essentially what's been going on. Powell's even called them out, essentially saying that the numbers don't look correct. Just before Jackson Hole, and then ultimately leading to essentially the revision of 818,000 jobs and potentially even more, because we don't have a quote unquote official numbers yet, which I'm sure next year will be extremely shocking, and showing that we've been through a depression for a long time now. Could be still in a recession, close to a depression, but I believe by next year we will be officially in a depression, as things will get worse from this point. So what we learned, again, that Fed Powell had stated, one of the biggest takeaways I got from what he said was essentially that they should have probably cut in July. There was a lot of Fed members saying that they probably should have cut in July before we had this meeting and this rate decision. But now you're in the last quarter, you're going into the last quarter of the year. You have to understand what all that includes. So this is why I have what's next on here. So ultimately, this is what we were waiting for. We're waiting for a rate decision to kind of determine where we were going to go for next steps. Now, we also did get the projections of what's going to happen. I don't like going off of projections because, again, unless it's the next rate decision, potentially even the second one after the current one you're going through, those are the only ones that really matter. And it's really just the next rate decision. The ones after that can change a lot. You have to understand that there's a lot that comes into play that can influence the size of the rates and the direction of the rates, just depending what's currently going on. And so, being said, what we got for the remainder of the week was essentially we had the rate decision. The market sold off a little bit, and then the market started ripping back up, going back to all-time highs. And then we had essentially quad witching on Friday, so you had a lot of money coming off the books on Friday, and then kind of leading into the last 3 months of the year. Now we only have 2 more rate decisions scheduled for the remainder of the year, November, December. We have a whole month, which we won't get anything, but we will start kicking off earnings. And this is the next step we got to start watching, is earnings. And we got to start watching unemployment getting worse. Yes, we are going through a point where unemployment is, or new job creations is coming to a screeching halt. Some of the worst new job openings we've seen in a very, very long time. And we've talked about ghost jobs on here, about how one job is essentially replicated across different websites, and they account that as however many times it shows up. So you don't get very specific numbers there. And so this is why you get a lot of these revisions, and again, massively down revisions. So again, we had the SOM rule trigger just 2 months ago, You have to understand that with the revisions, that should have been triggered a long time ago. So you are going through a recession as we speak, if not a depression at this point. We won't know officially until we get through it. And then after the fact, they'll have to go back, and this will go back is one of the most historical times in our history when it comes to economics. And so, with that being said, we have to start focusing on what's next. I've talked about the bonds, I've talked about commodities. Now, just because they gave the rate decision on Thursday doesn't mean stuff just flips overnight. That's not the way this works. You have to understand the way rates work. Once rates are adjusted, it takes anywhere from 6 to 12 months for that essentially rate decision to have any kind of impact on the market, because ultimately what it does is you're waiting for companies and consumers essentially to or really more so companies, but you're waiting for companies to let all their current loans come to maturity. Now you have to understand is next year we will have a lot of loans coming to maturity, and the rates are currently still very high. Now the problem being again is when you are coming from almost a 0% interest rate to our current interest rates, even with the 50-point deduction, it's not a lot. People just can't afford it. And so a lot of people, I should say businesses, just can't afford it. And so it essentially stunts their growth. It essentially forces them to continue to lay people off because they just can't afford it. And so you have to understand again, small business makes up, I believe it's roughly around like 65-70% of all jobs out there. And it's going to shutter tons of these businesses, small businesses that can't sustain. And you have to also understand that at the same token, you have a bunch of mid to small banks that are currently being propped up essentially from the Federal Reserve, and essentially bailing them out, which we've seen a couple months ago. It's been very quiet over the past couple months when it's come to banks, but they are, again, stealthily, they are bailing them out because of the fact that they need to get this thing over the finish line when it comes to the election. You don't understand the hoops they jump through and the corruption that goes on when it's an election year, and what they do to try to make things look a lot better than they are. So I said there's always a utopic view because you have to be able to control the narrative. If you can't control the masses. And if the masses really knew what was going on, again, people would pretty much lose their shit and things would not be great. And so with that being said, the Fed themselves are in a very interesting position. Now, with the projections, what we're looking at is we're still looking at 50 more points, but I'm also seeing around the rumor mill that there may be more than that. There may be 75, which leads us that we're going to have to do another 50-point basis move, which again, I've talked about the size of the rates. If they are a 50-point basis move, that is commitment. That is committed that they have to start cutting rates. And more so, it took a lot of people off guard. It even took me off guard that they were going up to 50, because that means, okay, well, we are committed because something really bad is happening at this moment. But they're not going to tell you that. And Powell didn't say that, obviously, because he's not trying to. He knows the power of his words, and again, he could be potentially the most powerful people in the world because they control the money supply, and the words that come out of his mouth hold a lot of weight, more than even the president. And so you need to understand that, and understand that again, he's not going to come out and say it, but you have to go off the action. 50-point is they are committed to having that. They have to start cutting. It's not an option at this point. Being said, we see another 50-point basis move. We see a 75-point basis move. That is concerning. That is, I think if we get another 50-point basis move before the end of the year, that's panic. I think we're very close to panic right now. And if you would have went up to 75, that would have been sheer panic, because I've talked about if it's 75 or 100, that's just sheer panic. And we are close to that. And so that's what I'm saying. As of right now, what's going to happen is you have the 6 to 12 month window in which these rates actually start taking shape and actually have an impact. So in that 6 to 12 months, things will get way worse than what they currently are, and they'll start accelerating at a very, very rapid pace. And we're starting to see that with layoffs. Is my feed has essentially been filled up with tons of people getting laid off. Layoffs and bankruptcies are continuing. people have no savings. Essentially, delinquencies, essentially debt, personal debt is going through the roof, historical highs. It's way worse than even the pandemic. A lot of these things are getting absolutely absurd. What's going on? And so, with that being said, the Fed have to do something. They have to cut. It's not. They don't have an option. They can't worry about inflation anymore at this point, and hope that you'll understand when you cut that inflation needs to come back slowly and not come back rapidly. And that's the concern. And when I talk about why you have to watch bonds and you have to watch commodities, because if inflation comes roaring back, then we start dealing with a situation like we dealt with back in the 70s, where we thought we defeated inflation, and then inflation came back way worse than it ever has. And that's the big concern. When you print out all the money that they did, this is what's going on. And understand, again, that the banking system is very much to blame for this. And this is what happens on a debt-based system, and it screws everybody. And so at this point, we are really waiting, and we're waiting to see how nasty these earnings are going to get. That's the next thing. As we are turning the page, the next steps, that is what we're looking at. We're looking at the earnings and unemployment getting worse and worse and worse. And again, they'll continue to try to at least give one more good showing if they can, which again, because it hit all-time highs, with this massive market manipulation, people are like, oh, we've hit a turning point. And yes, I'm not downplaying that we haven't. We finally hit a turning point. But you have to understand that it's going to still take a year for us to really come out of this and understand within that time, housing, automobiles, and the stock market, everything's going to correct even worse than what it already has. And then it will start to get better. And so it has to get a little bit worse before it gets better. And so with that being said, it puts us again in a very, very interesting spot moving into, again, this earnings cycle is going to be bad. Q4, Q1, Q2 of next year are all going to be bad. Potentially Q3 of next year, we might start to see some sort of recovery, especially when you're coming to AI infrastructure type of plays. I think towards the tail end of next year, the stock market will be doing better again. But you have to understand, you have to let this thing play out. And the fact that there's been so much manipulation over the last decade on keeping markets propped up, it makes these recessionary price-ins a lot worse. And so again, we are starting to, we're getting that yield curve inversion where things are starting to try to correct. And we're at that telltale sign where things correct, and they correct hard and very fast. When I say fast, it's not next day. You have to give it another quarter, and then we'll talk and see where we're at. So when we get into the new year, we'll see where we're actually at. When we're looking at unemployment, we're looking at earnings, and then obviously earnings for Q4 isn't reported until March, and that's when we really correct, and we could get official numbers on actual unemployment until we get into that recovery stage. And by that time, we don't know how much we're going to be cutting by, as we're looking for some bigger cuts here coming in the back half of this year, and then a lot potentially around the February-March period, as we try to. This is the whole soft landing thing. That's not going to happen. Whenever the yield curve has been inverted, especially for one of the longest durations that I think it has been in ever, that is a big problem. And understand me, the holding that yield curve for longer than anticipated is a very bad thing, and always turns out to be a hard landing. And again, meaning that there's going to be more layoffs because companies can't hire, they can't get to the new loans, they can't do any of these things. And so again, it's going to get very, very nasty before anything gets better. So again, that's where we're currently at. Next stages, again, we have to continue to watch. You just have to be very patient as this plays out. And then again, earnings are another big thing to watch. Again, and my big thing too is once the election is done, you're going to start getting a lot worse news come the new year. Once the official, it may even start dropping by the time the election is done. And then when the election is done, you're going to start hearing all kinds of news going into Christmas and then going into the new year, which we'll see what happens, but looking for a lot of things to implode at that point. So with that being said, that is what we're looking for next steps is earnings. We have to take this step by step. Again, we don't want to project too far ahead because there's too much uncertainty about what could happen. And essentially institutions aren't going to get in if they don't know what's happening over the next 6 months. And right now you have an election. That is the biggest thing on the docket. So you have to wait for that to pass. A lot of people I hear, even in the housing sector, a lot of people are waiting to put their house up for sale till after the election. People want to know, they want some sort of stability, at least kind of at least see what's next before they make that next move. And so, not that it's really going to make a difference, but nonetheless, they want to see that next move. And so that's why you're not seeing anything just yet until after that fact. And then after that fact, then there'll be some bigger changes at that point. So with that being said, long rant, there's a lot going on. So just trying to kind of pave the way, what next to be paying attention to. And again, much along the same lines, how we've gotten to this point, we want to start, again, looking at those things that got us to this point. FedEx was another big one. FedEx had earnings and they lost, I think, about $1 billion. Shows you, again, where the consumer is at. They're not willing to pay for fast deliveries anymore. They can't afford it. They don't have excess cash. Again, another reason why you watch earnings, because things are not in good shape. And you need to watch those same pulse of the markets to kind of understand where things are at and when they start turning, when they start exploding because they beat expectations by a wild amount, is what you're going to find next. And so what we're doing is now that we're actually cutting rates, one thing you need to be paying attention to now is now your savings rates in banks is going to start dropping. So people are going to start shifting their money out of savings accounts in banks and start putting them in dividends. So if you haven't been accumulating dividends at this point, which I've talked about a couple of dividends over the past couple of months that have already pushed up, but people are going into dividends until essentially tech corrects because of what's going on in the market, and we start seeing potentially increase in inflation again and mass panic because of the rate cuts. That doesn't just assume that things are just going to come out roaring back and the printers come on. And we're watching what's happening in China. I keep reiterating this. It happens overseas before it happens here. They have done historical printing and it has not saved their market. Their market is continuing to sell off and continuing to crash. Now, it's not saying that's going to happen as bad as us, because they have Evergrande and Country Garden and a lot of just a lot of major issues going on there. And again, even with our political stance as of right now and potential war and everything on the brink, these are all things you have to take in consideration that could play into this. So that, again, like I've said, they always need a reason to cut rates, cast whatever blame they need to cast on whoever's blame, whatever it is, to start selling off and understand what the underlying problem is the banks, the yen carry trade. Carry trade is big. There was a big, even going in the back half of this week, there was big concern that if for some reason they started increasing, Japan started increasing essentially their rates, with us decreasing, that would cause a huge collapse. And so that's why there was a big concern about what was going on last week as well. So, but they didn't increase rates, but it's not saying they can't. Again, they can only do so much. If it starts to turn on them again, they're not going to just continue to let this happen. And then we're going to suffer from that if that does happen. So just be aware. And your yen carry trade just happened, about a month ago. That can happen overnight session. Just be well aware of that. So with all that being said, this next week we do have GDP numbers. This is second revision coming out on Thursday. Again, they said that could be revised down to even lower than what we're actually seeing. So just keep that in mind. We do have the Fed co-hosting a 10th annual U.S. Treasury Market Conference. So you'll have a lot of Fed members speaking on Thursday. Powell will come out for the initial statement. Again, if it's scripted, it's not really going to have any kind of impact on the market. But if he's an open forum, it always could have an impact if he's speaking. And then we have core PCE on Friday. Again, not really expecting data at this point. Really is irrelevant till we get rates the next 6 months. I'd probably say the next quarter, over the next 2 quarters. More so probably in Q1 of next year. You really want to start watching essentially oil and everything again, commodities and inflation rates again, because that's when it's really, you could potentially start seeing the signs of a lot of these things turning around and potentially getting a lot worse. And so that's when you need to start really paying attention. So that's what we're kind of looking for there. But this week, again, I don't really see a lot of core PCE. Really doesn't matter. It never really matter. It kind of gives you leading insight in what is potentially about ready to come. But again, ultimately understand that at this point, it's not that big of a deal. Monetary policy. We won't have it till November, December. Again, a lot's going to happen. We'll start getting some earnings, so at least they'll be able to know in November how bad it's going to get. so that November could be our 50 and then maybe a 25 for Merry Christmas. We don't need to panic too much maybe in December. But again, projections will matter on the December one as well. So that will be a big event. Core inflation, again, at this point right now, it's too early for core inflation to really start rising. So I would really start looking more into the new year as opposed to these next couple of months. Could see more of an uptick, but I don't think it's just normal. When you start cutting rates, you will see some uptick in inflation. But again, ultimately understand, again, the health of the consumer and the business is still very bad right now. And again, 50 points isn't going to be enough for these businesses to do anything. But again, the Fed can't come out and just say 100 points right now, because especially when you're coming from a paused environment to 100 points, that means you completely messed up. And 50 points is even alluding to the fact that you messed up, but it's even just more so definitely guaranteed that you did mess up. It's 100 points. So, and then this week, as you can see, everything is kind of correcting back down. SPX is back down to 75, so not really expecting much going on this week. Obviously, we're going to start rolling into earnings. We're going to start hearing a lot more news about bad stuff, getting a lot of news about a lot of just crazy stuff going on in the world as well. So just keep that in mind. There's a lot of politics that play an account, and there's a lot of fraud, and there's a lot of X, Y, and Z that are going on that, whether you want to believe it or not, it happens all the time. And so a lot of people would rather not just live their own lives and headline news, and that's about the extent that people want to go. There's nothing wrong with that, but then again, you can't also cast blame on people that do the research and actually see these things happen all the time, and then say that no, they're wrong. You wouldn't know unless you dove and went a couple layers deep to understand what's really going on in these different avenues. So again, it's looking pretty regular this week as far as numbers and expected moves. So not really looking for a lot there. Again, just waiting for earnings at this point, waiting for non-farms, just waiting for those numbers to uptick. Again, you're going to get a lot of headline news. You're within under 60 days of the election, so you're going to get a lot of news from that. So just keep that in mind. Every weekend, I think, is really going to matter. And I think you're really going into the election, you're going to hear a lot of big news on every weekend. Keep that in mind. And again, if anything happens here domestically, that can impact the market. More so, if anything major happens, it can get to a point to where they can shut down the market. So you do have to keep that in mind. We're in that kind of environment right now. We're not always in that environment. Yes, there's always potential black swans, but at this point, you have too many black swans in the pool. This isn't something that is normal. And so it needs to correct. And once it's done correcting, and then you get rid of some of those black swans, you get a reset on a lot of these things that are being price gouged at the moment. I think, next summer, I think we're going to be talking about some deep discounts on a lot of things. And at that point is your opportunity. And if you're able to survive this long and able to take advantage of that opportunity, hopefully you are. I think there's a big swing in the way things will go here in the next couple months. So just be prepared for that and understand things will get a lot worse, which again is sad to see. But on the same token, you have to be neutral, have to remove emotions when it comes to markets, and you have to take advantage when those times come. So with all that being said, if you made it this far, go ahead and drop a like. And until next time, I'll see you guys later.